Our next guest forecasts a string of 3 consecutive 25 basis point rate cuts this year. Goldman Sachs chief economist Jan Hatzius joins us at Post 9. Welcome.
Good to be here.
What did you make of the jobs data as it relates to the question of what the first cut looks like?
I think it was a little weaker than expected. We thought that the payroll number might look a bit soft, but it was slightly below our forecast. There were some downward revisions. The household survey basically did what we thought. So I think you could certainly make an argument that the funds rate is very high and you should move off a 5 handle. And so there is a rationale for a 50 basis point cut. Just like last time, I thought there was a good case for doing a 25 basis point cut. Whether that's what they will do is less clear. I think at this point, to me, it looks more likely that they do 25 with a clear message of ongoing cuts, with, of course, signals that there will be more cuts to come. You know, if you look at what Chicago Fed President Goolsbee said earlier in the week, a case for a string. But there's still some information to come, of course, in particular next week's inflation numbers. But at this point, I'm still with 3 consecutive 25s in the rest of the year.
Yeah, we have Goolsbee on with Stephen Money Movers in the next hour, so it'll be good to get his first reaction and whether he'll tip his hand. We haven't really heard any members of the Fed say we need a 50. We haven't heard them necessarily rule it out, but I do wonder if there would have to be bigger problems underneath the surface because, as you say, the report was weaker. However, wage growth was firmer than expected. The unemployment rate actually fell, and the overall number represented an increase in job growth from July and June. So not all bad.
Yeah, and there's also, I think, a process issue in the sense that there's not only a rate decision, but there's also a dot plot. And there is the messaging from the committee, and many participants, until very recently, were not really convinced that they should be cutting at all. So whether you then end up with a 50 basis point cut because the leadership has had a very strong view, but the dot plot shows only relatively little beyond that, that would also be, I think, inconvenient from the perspective of sending a unified message.
The other news from earlier in the week took a look at productivity and labor costs. And I heard some argue that it closed the door a little bit more on the notion that inflation would somehow rear its ugly head again, or we get some kind of double top. Does that seem fair?
I think that's right. Unit labor costs, barely up over the last year. That's certainly encouraging. So even with nominal wages still growing close to 4%, above where we were pre-pandemic, ultimately the question is, does that translate into unit labor cost growth and into cost pressures that would lead to inflation being sticky above 2%? I don't see that in the numbers. I would agree with you that this was also an incrementally encouraging signal.
You're still at 15% recession odds? You don't see tinkering with that metric anytime soon?
Well, we are at 20% at the moment.
20.
We lifted it to 25 on the back of last month's report and then shaved it back down to 20%. So 15 is the unconditional average, 1 recession every 7 years on average. So we think we're a little above that, but 80% is a pretty big number.